Hello, everybody. Welcome to Talk About Houses. I'm Todd.
I'm Juana.
Okay, so today we're going to talk about mortgage interest rate predictions for 2023.
That's exciting.
These are not our predictions. We're not making up numbers. There are 5 experts in this space.
Okay.
Analysts, economists, people like that work for some of the big companies. And when we go through them, we'll identify each person so that you'll be able to see what their predictions are. And then we have a really cool chart at the end that shows like a graph of the interest rate of predictions.
Okay, so here's my question. How many of us think that they have one of those spinner things and that's how they come up with the predictions?
It could be a complete guess. So actually before we jump into these predictions, you're probably saying, well, how do they come by these? There's economic models that they build. And the economic models try to take everything into account. And they look at the past too, and they analyze things that happened in the past. As we go through these, we'll sort of talk about them and what things they're looking at. So anyway, all these came from a massive article, but it said mortgage interest rate predictions where rates go down in January 2023. What's interesting is they talk about all of 2023, and they talk about specifically the next few months. Okay. So we'll start with the baseline. 2022, mortgage rates fluctuated. The lowest the rate was in 2022 was 3.22% January 6th. That was the lowest it was. Now, as some of you know, in 2021, it was like 2.7 or something. It was pretty low, okay? The highest it was 7.08% November 10th. It's actually below that.
Yeah. Now,
Juana, let's talk about this. The Fed has raised rates since then. Why did the interest rate go down? Like if the Fed raised rates, why aren't the interest rate people, the mortgage banks, automatically raising rates 0.5% like they said? The Fed told them to do it.
Well, the Fed didn't tell them to do it.
Oh, they didn't tell them to do it. So that's not what it means. When the Fed raises rates, those aren't mortgage rates they're talking about.
No.
Okay.
So the mortgage rates are actually very forward-looking because remember they are loaning money out long-term, and what the Fed is actually regulating is the short-term interest rate, not the long-term interest rate. So mortgage rates are based on the long-term outlook, and that takes into consideration what they anticipate in the economy on a variety of levels.
Okay.
And they also want to be sure that they are loaning money at a rate where they'll be making profit, and they will not be loaning money out so far below what the market is at the time that they're losing money. That they're already doing that with the 3% mortgages and the 2% mortgages and so on.
Yeah, they're getting crushed right now. I mean, from that.
Right, but they also need to make sure that they stay competitive against one another.
Okay. All right, so we're going to hit the first prediction. Nicole Bashad, senior economist at Zillow. Prediction: rates will moderate.
Yes, I agree with that. I think rates are going to bump along, but I don't expect rates to go particularly high or particularly low. I think they're just going to keep kind of doing this within a pretty narrow band throughout the year.
Okay, they were given 3 choices. They would go up, they would moderate, or they would go down. Specifically, she said, we've seen inflation numbers cooling off for the past couple of months, and mortgage rates responded by following that. So she's looking at inflation numbers, not necessarily what the Fed is doing.
Right.
As that inflation continues to come down even more, that will help take some pressure off mortgage rates. We're not going to see as many rapid rate movements. We'll likely see rates stabilizing, coast around the range there. In now for the next couple of months. Right.
And I agree with that. I think if we do see mortgage rates go down a meaningful amount, it will certainly be in the 3rd or 4th quarter. I don't expect that to happen in the 1st or 2nd quarter.
Okay. The next one is Nadia Evangelou, senior economist and director of forecasting at the National Association of Realtors. Prediction: rates will drop. That's her prediction. Mortgage...
So now these economists are looking at what the rates will be at the end of 2023 or throughout 2023? Like where in the spectrum are they, or are they in different places?
Throughout the year.
Okay.
Mortgage rates will likely start the year near 6.2%. That's less than they are now. Mm-hmm. Now, remember, that's a week from now. Two of the main factors affecting today's mortgage market have recently become more favorable. Mm-hmm. So she's looking two of the things that are favorable. Inflation continues to ease, while the Federal Reserve has switched to smaller rate hikes. And we'll talk about that in a second. 2022's higher federal funds rate has started to tame inflation. Thus, mortgage rates will likely stabilize below 6% in 2023. So she's predicting below 6%. Mm-hmm. Now, the Fed put out 9 months ago this sort of long-term thing that it was going to do. Mm-hmm. And they've backed off that a bit. The last two rate hikes were supposed to have been 0.75%, and they've been 0.5%. Mm-hmm. And then their language going forward is that, you know, they may leave rates steady, but they would potentially not exceed the schedule of raising rates.
Right. So this is more complicated, by the way, than just the inflation numbers, right? Uh-huh. I think the thing that isn't being talked about very much is the federal debt.
Okay.
And, you know, these interest rate hikes are having an impact on the federal debt. And what I mean by that is the amount of the rate at which the federal government borrows money in order to keep itself going, because it's not like the rest of us. It just keeps spending more than it's bringing in.
They just passed a massive multi-trillion-dollar
right.
spending package.
Right. So the federal government is the only entity, not like the rest of us, that has to, you know, the rest of us have to live within our means. Federal government does not. But at the same time, because they are living beyond their means and because they're constantly borrowing money, all these rate hikes that the Fed is doing are negatively impact the government's ability to borrow money and service the debt, because more and more of the budget is being devoted to debt servicing. So, and of course, the government has no intention of, you know, spending beyond its means. So there are a lot of reasons why the Fed is cautious about continuing to raise rates, because there are other pieces of the economy that are negatively impacted by that and can trigger other negative effects in the economy.
Okay. The next prediction, Selma Hepp, Deputy Chief Economist at Corelogic, their data analytics company. They specialize just in real estate. Mm-hmm. Rates will drop. So we have right now we have two drops and one moderate. Mm-hmm. That's their prediction. I think mortgage rates could continue to fall but remain above 6% in January as inflation shows sign of pulling back, and a few economic indicators point to some early signs of economic weakening. Mortgage rate spreads, while still elevated, have been shrinking. This is also driving the decline in rates. Investors may be anticipating the Fed pulling back monetary tightening sooner than the Fed is currently communicating. Okay, so if inflation gets under control and the economy starts to tank a bit, they could ease their policy to try to keep the economy going. That's kind of the tightrope they're trying to walk right now, right?
Right.
And real estate's getting caught in that to some extent, because mortgage rates, they don't look at what the Fed rate are today. Like you said, they actually more match the 10-year Treasury note than they do whatever the Fed says.
Right. You know, to me, the housing market is the 300-pound gorilla in the room, and the Fed is trying to handle inflation against this, you know, behemoth. But the problem is that it kind of reminds me of like horizontal blinds, where you're kind of having to pull the two levers to even it out. And you're pulling one side, and now this is uneven, and you're pulling the other side, trying to even out. Now this side's uneven, and that's kind of what the Fed is trying to do. They're trying to find that Goldilocks spot.
Right.
And it's very difficult to do because there are so many variables in the economy. So the idea that it's one or two things is oversimplifying the complexity of the economy, and the Fed doesn't have that many levers to pull, unfortunately.
And one of the major things that affects inflation is energy prices.
Yes.
And there's a war going on in part of the world that, you know, where they're oil producers. Well, and that's negatively impacted supply of oil.
Right. So we're talking about energy in that way. We're talking that we've stopped being energy independent, and that's a problem. And then we're talking about other things in the economy related to food, related to goods being able to be transported across the world. So it's a very complex system.
Okay, the other thing too that never gets mentioned is real estate is a major measuring thing for inflation, but it lags. And we know real estate values have been going down and rents have started to come down, but that data is not fully, in those inflation numbers that you've been saying. So
Right.
that's another, like those are four, and I think that's one of the things they're talking about. These are forward-looking things. They're looking at forward at the things that for inflation that potentially are bringing it down.
Right. So they're looking at things the way we look at things, where when we do the market report, where we're looking at the solid line, which is what has been, what we have strong data on.
The 90-day average.
Right. And then they're looking, if you will, at that dotted line, which is the leading indicator. Right?
It's the last 7 days, which
Right.
are more, because 90 days ago, that was what it was, but the last 7 days are more indicative of what's going to happen.
Right. Right.
Okay.
So I think that's what these economists are doing, is they're trying to look at the leading indicators to extrapolate from that what will be. But 12 months is a long time in an economy.
I know. Yeah.
And so I think it's more of an educated guess than anything that they can really back up by solid data.
Okay. This is the fourth one. So we have one moderate,
Mm-hmm.
and two down.
Right.
Okay. So this is Odetta Cushy, Deputy Chief Economist at First American. First American has a ton of real estate data. They're predominantly a real estate data firm. They have so much real estate data, they actually have a title company attached to them. They issue title policies. Mm-hmm. So they're, prediction rates will moderate.
Right.
Okay.
So nobody's predicting 8% interest rate, guys. That's really what this is about. So interest rates, basically, according to the experts, not to us, according to the experts, interest rates have basically peaked.
Okay. We'll do the quote now with some analysis. Mortgage rates will continue to face upward pressure until inflation convincingly cools. The Federal Reserve has made clear its stance will remain hawkish until inflation begins to approach its desired target of 2%. However, recession fears and any new data suggests inflation is cooling. May put some downward pressure on mortgage rates. As a result of these push and pull factors, that's funny you mentioned that exact same thing.
Mm-hmm.
Maybe moderation in mortgage rates.
Mm-hmm. The good thing about next year is that it's not an election year. So there's hopefully a little less politics involved in the interest rates, and more of an earnest effort to drive the economy in a meaningful way that's beneficial to everyone involved.
Okay. Now, when mortgage rates have risen in the past,
Mm-hmm.
the longest the period they have raised have been 18 months.
Mm-hmm.
The longest, historically. After 18 months, they always drop. Now, we started the year, at the end of last year, we were still below 3. We started the year right at 3, we'll call it.
Mm-hmm.
We hit 7%, which was the peak. They went at 4%. Now, it started to drop.
Mm-hmm.
So it could have been that we just had a 9 or 10 month cycle
Mm-hmm.
of interest rates that we won't know for like another year.
Mm-hmm.
But the most we've seen is 18 months. So it's likely when we show you this chart, it'll be more obvious
Mm-hmm.
with what's happened.
Okay.
Okay. All right. The last one. So we have 2 to go down and 2 to moderate. The last one is Rick Sharga, Executive Vice President of Market Intelligence at ATTOM Data Solutions. Prediction is the rates will moderate. ATTOM Data Solutions, they're just a data firm,
Mm-hmm.
and they predominantly real estate data.
Right.
And we use a lot of their data in analysis on our videos.
Mm-hmm.
Okay. Now remember, they're all looking at the same factors, but they look at them in different ways potentially.
Potentially. I think that I really think that they're looking at very similar factors. I don't see because their conclusions are so similar and because their language is so similar, I think that they're looking at a very narrow set of factors.
Mm-hmm.
And I don't think that they're considering black swan events. I don't think that they're fully considering maybe some of the things that the rest of us would consider, particularly those of us who live in states where our legislature meets every other year.
Right, sure.
Because we just had an election. Those of us that do not have full-time legislatures are so looking forward to the legislature being in session in January. If that was not sufficiently sarcastic, I need to work on that. Look, nothing's safe when the legislature is in session.
Yeah.
So in Nevada, our legislature will go in session in January, and they will go through April, and they might even go into May. We hope not.
I hope not. So the governor flipped,
right,
from blue to red. Mm-hmm. What about the House and this? Do we know what the House did? The legislature?
So
did it flip to red?
There was some shuffling around. I think it's still pretty tight.
Okay.
But so it'll be interesting.
Hopefully they won't change anything then. They'll just
nothing's safe when they're in session.
Okay.
Okay. And so when was the last time that they lowered our taxes and didn't cost us more money?
Fortunately, in Nevada, we don't have a state income tax, but they find other ways to draw taxes through other business taxes and other things that they tax for.
Right. And, it's not that they're not well-meaning. I think that a lot of them are very well-meaning. I just think that they don't consider the unintended consequences that invariably make a great impact on a lot of people.
Okay, here's Rick's, the quote from the article. Mortgage rates will probably be more or less flat for most of January, moving up or down within a fairly tight band, perhaps between 6.25% and 6.5% for a 30-year fixed rate loan. Which is much lower than the crashers said we would have 8% rates. That's what they were basing all their ridiculous numbers on. That never happened. Actions and comments by the Federal Reserve have generally been the cause of more rapid spikes and declines in mortgage rates recently, and the Fed isn't scheduled to meet again until January 31st.
So, those are all really good points. One of the things to kind of keep in mind is that recently lending guidelines have changed, and they've loosened, and that is a concern to me going forward.
Okay, and we'll talk about that after we talk about this next chart.
Okay.
Because we'll have the chart up, and then we'll just sort of talk about it so people can look at the chart. Okay. So we finished up with 3 moderate. Mm-hmm. They would moderate. Mm-hmm. They would basically meaning they would just bounce around. They would stay in some form of equilibrium at some amount. Mm-hmm. And then 2 that they would go down. And then there is sort of this, all of this was put into some model that showed this projection. Okay, so I'll put up the chart. Now this is a mortgage rate forecast for the next 90 days. Everything, the blue area where it says projected is the projection. It's a made up number, but this is what they're guessing. Now, what's interesting is everything else is fact. This is the history. This is back. If you look back, starting in about the middle of the chart, which was the beginning of 2022, mortgage rates were hovering around 3%, and then they took off. Now, historically, these would go up for 18 months at the most and come down. It looks like we've had, call it 11 months of raises, of interest rate increases. But you can see it's noticeably dropped since November. And November 10th was the high. This is Christmas. Mm-hmm. So it's, so November 10th to Christmas, it's dropped substantially. And the projection is they would continue to drop. And this potentially could be the thing that, really, this combined with, mortgage rates being not out of reach for people. There's still some, because prices have dropped. So that makes homes a little more affordable. Now, interest rates, so you have the two biggest affordability factors. Interest rates and home prices have dropped home prices have dropped in the last 6 months. Interest rates have dropped in the last 2 months. Homes being more affordable now, more potential buyers. That could be the soft landing that we talked about.
Well, I think the Fed is also concerned about consumer debt. And that's something we haven't touched on. So by consumer debt, I mean credit cards and other short-term loans like cars and that sort of thing. So those interest rates have spiked. And I think that's a concern because it does go against a borrower's debt-to-income ratio.
Okay.
So now, maybe interest rates have moderated, maybe home prices have gone down, but if the debt that you're servicing for an auto loan or for credit card debt is causing you to have to make larger payments on that end, then this is not really helping any. So yeah. I think that's one of the things to kind of keep in mind. There are other pieces. Like I said, it's a very complex system, and there are other competing factors as far as that goes.
You know, a lot of those people weren't getting houses anyway because there were, 10 offers on one house.
Right.
So you had excess amount of demand.
Mm-hmm.
You had excess demand. And not saying that we'll have excess demand. Obviously, there was this huge last gasp of two things what I think were happening. One were people were looking at rates going up and were jumping into the market trying to just secure that 4.5% rate before it went to 6 or 8, which was some people's predictions. And then you had all these sellers who came into the market early. Hey, I'm going to sell my house in the fall or next year. I'm just going to get it done now because I've told prices are going to drop by half. I'm just going to sell the house and rent it back or just sell it and move now and just put the money in my pocket and defer the risk.
Yep. And, people who did that did well.
Yeah, I think they did.
I think they did. So, you've got that going on. Like I said, the economy is a very complex system.
Right.
And so I think, these things have to be kept in mind because when somebody's borrowing money to purchase a house, they generally have other debt like car payments and credit cards and that sort of thing. And when that debt that they're servicing is elevated as far as the monthly payments, then that reduces the amount of debt and monthly payments that they can carry on the mortgage end.
Let's talk long term.
Okay.
There's more likely to be less homes built than consumer demand. Investors are still buying.
Yes.
We know they're still buying. They will likely lock up more homes that will be permanently in the rental pool. Interest rates probably won't ever go back to 2.5, but if they get down to 4, that's still pretty reasonable. Home prices will likely decline until the spring, and then we'll have to find out, right? Year over year, they're still up. That's the interesting thing. They're still up year over year. Like if you bought your house, all other things being equal, if you bought your house a year ago, it's still, if you try to buy it today, it would cost more to buy it today.
And the interesting thing is, you said that, home prices will continue to decline, and that's probably true. But, we still have buyers buying homes. We still have multiple offers on properties.
Yep.
So the right property that shows well, that is a desirable area, that has, all the things that buyers are interested in, still generates a lot of interest, and it still gets multiple offers, and it still sells. When you look at these homes and you see a home that maybe came on the market for, $800,000, and then it ends up selling for $700,000, you think, oh my goodness, they had to take $100,000 haircut. Well, maybe not. Was that home ever worth $800,000?
Yeah.
And that's something to kind of keep in mind. So the numbers as far as home prices declining, you have to kind of take that with a grain of salt. Because, was the house worth $700? They priced it at $800, hoping that somebody would just buy it, and then ended up taking what the home really is worth, which is $700. Should the home have come on the market at $700 in the first place? Maybe. So kind of keep that in mind when you're looking at these numbers.
It's interesting. If you look at the home price appreciation, and you just lop off last spring, that like it didn't happen. Forget what those prices were. Just pretend that was fantasy. Home prices have gone up consistently. They went up at a higher rate in 2020 and 2021, and then they've basically plateaued and stayed the same. So people are pointing at that super high point and going, this is a housing crash. That's not a housing crash. Home prices are worth more than they were a year ago, way more than they were 2 years ago, way more than they were 3 years ago, and even more than they were 4 years ago. That they're just coming back to like a normal level.
Right. So please, consider not judging home values based on the high water mark.
Yeah, that's a little bit ridiculous. That's not like, because the thought that that's the equilibrium price is a bit ridiculous.
Right.
When home prices did what they did in 2008, 9, and 10, which if you take that long-term trend, of home prices appreciating at 5%, just back to 2019 and keep going at 5% a year for the next 3 or 4 years to get to today, we're still way above it. We're still way, way above it. Home prices have to go below that line before they crashed, and we're not anywhere near it. We'd have to decline another 30% almost
right
from here. And looking at what interest rates are doing, and that real estate is sticky in a way. It takes the market longer time to react. I consider last spring a complete anomaly. When we started the year, we even said we thought home prices would go up, 7 or 8%. And they went up by less percent, but still this whole, mortgage rates being the factor that was going to kill the housing market, that's done. It's in the past.
Right.
Mortgage rates are down, substantially down.
Yeah. Going back to what I said, though, as far as lending guidelines changing, that is a concern for me going forward.
Okay. Tell them what you mean. Okay. Lending guidelines changing. How does that work?
Okay. So they're changing they've changed how they look at credit scores.
Okay.
So let's kind of talk about that for a moment. So, for example, before that, they would, if you were borrowing the money by yourself, that they would get 3 credit scores from the 3 credit reporting agencies, and they would go with the middle one. Now they've changed that, particularly if you've got a co-borrower. So, for example, if one of you has a lower credit score and the other one has a higher credit score, they will kind of meet you guys in the middle, and so that helps borrowers borrow money, which is good on the one hand, but on the other hand, I think it may allow people to get into real estate who maybe are not ready to do that.
Okay, but look, hold on. The mortgage lending business is a business.
It is business.
And they make money by giving loans and selling the loans on the secondary market. And there are regulations that they have to follow to sell the loan.
Yes.
Meaning there's this underwriting criteria that has to be met for some other investor to buy it, to not repeat what happened previously with a free-for-all of just, crazy loans being written.
Right. So look, I think a lot of us have PTSD from the last time around, and we get very concerned when lending guidelines are loosened.
And if they're loosened too much,
right,
then we have everyone qualified to go buy, and all these people rush into housing again. And
well, but that's kind of a double whammy. You've got people rushing in to buy houses, so that puts pressure on housing prices, and that makes prices go up. Fine, that's all great. But what I get concerned about is people who get into a house who are not sufficiently financially stable to meet their obligation.
Right.
So that's my concern about lowering the standards for people purchasing homes, because look, a lower credit score is an indication of past behavior, and I do not have an AI to predict what's going to happen in the future. All I can look at is past behavior, and that makes me uncomfortable.
You can't put it in ChatGPT and say, well, there'll be more mortgage defaults in 2025 from people getting loans today. You know what?
If I can put that in ChatGPT, and then when we get to 2025, if ChatGPT was right, wow.
Yeah.
But I don't think I need ChatGPT for that. I think I can tell you that, yes, there will be, because it's just a natural thing when you lower the threshold.
If you don't know what ChatGPT is, it's an OpenAI product that's free that you can create an account and go use, and you can ask it questions, and you can have it write blog posts and YouTube video descriptions and all this other stuff. And it'll, you can say, write me a 1-page paper on the Peloponnesian Wars, and it'll literally write it in about 5 seconds, and you won't know the computer wrote it. And it's an AI that does it. It's right. Pretty fascinating.
And it's pretty clever.
It's pretty clever. Okay. So these were the interest rate predictions from, 5 of these people that are in the industry. You saw the chart. We'll probably in 3 months, we'll tackle this again. Hopefully we'll get some more. We'll be able to look and see how the interest rates going forward compared to what the chart said they would do. My gut feeling says they could end the year between 4 and 5% by the end of the year. Historically, that's still really low. In 2011, interest rates were still in the 4s. Mm-hmm. In 2011, they were in the 4s. This 2.5%, 3% thing was a phenomenon we saw in the last decade. We've never had it before. Could they go back there? Possible, but the 3 and 4% interest rates would not crush housing, because we've had 3 and 4%. 3 and 4% interest rates would still be historically low, and homes appreciated from the beginning of time until the 2000s with much higher interest rates than 3 or 4%. So I don't think 3 and 4%. Personally, I think what's happened with interest rates is great news. It's better than we could have imagined months ago when we thought interest rates could get up to 8%. That they peaked at 7 shortly and they started dropping again.
Mm-hmm. Right. So interest rates have not been as awful as we all expected, and that's a good thing. We'll see what 2023 brings. Please leave us comments and tell us what you think interest rates will do in 2023 and tell us the reason you think that. It's always interesting to share that with everybody. Please be kind to each other in the comments. Please subscribe, hit the notification bell, share the video, and we'll see you on the next video. Bye.
Bye.